a heavy lunch, I guess. Okay, let me just begin with a few questions in terms of trying to understand and gauge. We'll do a small poll which will help me understand whom I'm really speaking to. So, how many of you practice transfer pricing? Just raise your hand. Okay. And how many of you wish to practice transfer pricing? Okay, so there are some people I see, they've not raised hands in both of them. What are you doing here? Okay. And the last question, how many of you want Pakistan to win today's match? Okay, great. So I think they've made us a decent score, if not a good score. So let's see how Australia does. And then either of them wins. It's going to be exciting semi-final next week. Okay, so after lunch, it's actually a very dry topic, documentation. So I took a liberty to change the topic in terms of probably expanding the topic a little bit, because what was included in the curriculum was benchmarking, and I slightly expanded it to do with documentation, since this was not being covered by others, because I thought it is very important to discuss benchmarking, because benchmarking is the key to survivor transfer pricing assessments. Till now, I believe you've had a background from various speakers about what is transfer pricing, what are the various methods of transfer pricing, and I believe my earlier speaker also discussed some intricacies, specific intricacies on transfer pricing, and going forward also you are going to discuss a lot about practical issues, challenges specific to industry with regards to audit, certification, and various aspects. So what I am covering today broadly is what is transfer pricing documentation. I have actually a very small presentation. If I mention, I think it's about only 66 slides, and I'm just seeing the time allotted to me. I think it's about 1 hour and 15 minutes, of which 15 minutes I'm already late. So that leaves me 1 hour, that is 60 minutes, and 66 slides, there are some 60 slides, there are some, so that means 1 slide per minute. So my pace is going to be very fast. If you want me to go slow, stop me there and then and ask me questions, and that will also mean two things. Number one, you are interested, and number two, you are awake. So please ask me questions, stop me any point of time. As I said, the topic is documentation, slightly more theoretical, but we'll try to make it as practical, discussing my experiences. If you want to share your experiences, we'll look at that as well. If you have any specific questions, again that. And again, before I begin the presentation, I'm telling you, in transfer pricing, documentation is the key. Do not forget this. If you are a transfer pricing professional, and even if you are not a transfer pricing professional, in transfer pricing, documentation is the key. So what are we going to look at? What is transfer pricing documentation? What is a typical transfer pricing benchmarking study look like? Benchmarking analysis on databases, and key considerations for benchmarking, and 3CV something. There are a few slides which I think have been covered or will be covered by other speakers. So I will quickly just skip through them and come to the discussion of other slides. So when I made the presentation, probably I thought these are things which I should include, and I think this was based on my earlier years presentation, where structure was slightly different, and then I realized that after I made the presentation that structure has slightly changed, so there would be a few repetitions. We'll avoid that. What is transfer pricing documentation? Documentation means basically documenting each step of your process to determine whether a transaction is at arm's length or not. So it is documentation of a process. It is not documentation merely of a finding. Please keep that in mind. There is a difference between documenting a finding, which is the final answer, and documenting a process. So what does it involve? Identification of international transactions and also specified domestic transactions. So wherever I have mentioned international transaction, please read also specified domestic transactions included within. And associated enterprise, so identification of these. Functional analysis or FAR analysis, functions performed, assets deployed, and risks assumed. So for each party, who's doing what, who has what, and who undertakes what risk in a particular transaction. Then based on the analysis, selection of the tested party, based on the understanding of the transaction, the terms of the transaction, and the FAR analysis, who should be used as a tested party. What do you mean by tested party? Anyone? Okay. Tested party is the party to the international transaction whose profits are being tested. So whose profits you are benchmarking. So that means tested party could be either the assessee or the associated enterprise. So either of whose profits or prices you are benchmarking, that party will be treated as tested party. Identification of comparable uncontrolled transactions. So we identify transactions with whom we are going to benchmark our transaction. Selection of the most appropriate method. So after identifying the transaction, also identify which is the best method to determine arm's length price. Economic and functional adjustment. So once we determine the method, look at the comparables, you are required to make certain adjustments which would be on account of the differences in FAR or terms or any other differences which could be adjusted. Determination of arm's length price. Ultimately, after these adjustments, you determine an arm's length price by applying the selected method or the most appropriate method. And that arm's length price is then compared with the international transaction price to determine whether your transaction has been at arm's length or not. So this is the process of documentation in a nutshell, or process of transfer pricing, and documentation is involved at each stage. Unlike what we understand that TP study report is equal to documentation, TP study report is just one part of the documentation. So what is the year-end process that typically we follow, and I thought I should share with you. Before beginning of an annual compliance exercise for transfer pricing, we plan in understanding the background and prepare a plan of how do we execute the TP study report followed by the 3CEP. Then there is an information gathering exercise where we look at interviews and questionnaire. We meet with a lot of people, operational people, management people, to understand background of the transaction, understand the pricing mechanism, understand the due diligence carried out while doing the transaction or fixing the price. Characterization of entities. It is very important that we look at characterizing the entities to the transaction. The entities is the Indian assessee and the AE. Who does what? It is very important. Like for example, one of them is the manufacturer, other one is a distributor. Whether that distributor is a full risk distributor, limited risk distributor. It is very important to characterize because your comparability depends on characterization of the entity. Then we look at reviewing the agreements or arrangements with these parties. So this is all part of the information gathering exercise. Then there is a comparable data search or analysis. So what is the search strategy? What are the sources for search that we look at? What is the databases that we are going to use? Whether there is going to be an internal benchmarking or external data that we are going to look at. So based on facts of each case, this should be different. Then we actually carry out the benchmarking, and after the benchmarking, when you extract the data, as I said, for the differences, you make adjustments. So determine what kind of adjustments are required and what kind of adjustments are possible. While the requirement may be very high, the possibility of doing adjustment generally turns out to be very limited for want of data, for want of uniformity, for limitations in comparability, various aspects. And then ultimately document the whole exercise, or in fact documentation will also be there at each stage. This is consolidation in form of finally issuing a report and discussion with management, and then finally coming to the certification in 3CEB. What are the Indian regulatory requirements regarding the documentation? Section 92D lays out the responsibility of documentation on the assessee, and Rule 10D prescribes what kind of documentation is to be maintained by the taxpayer or assessee. So the documentation prescribed by Rule 10D can be divided broadly into three types of documentation: entity related, transaction related, and price related. While this documentation is necessary, this may not be sufficient. In addition to this, you may be required to maintain other documentation to demonstrate and prove that your transactions are at arm's length. So what are the entity related documentation? The industry profile, the industry to which the entity belongs, the group profile, the profile of the Indian entity, and the profile of the associated entity, associated enterprise. Transaction related documentation, the functional analysis for the particular transaction, the agreements, invoices, pricing related correspondence, and price related transaction, which is the terms of the transaction, the economic analysis, that is method selection, comparable, benchmarking, forecasts, budgets, estimates, etc. of the transaction or related data. Rule 10D exempts the taxpayer from maintaining such documentation where aggregate monetary value of international transaction does not exceed 1 crore. So where value of international transaction does not exceed 1 crore, you are not required mandatorily to maintain this documentation. But when the assessing officer calls for, you will have to satisfy him that your transactions are at arm's length. So there is no restriction on assessing officer to demand from you an explanation of where a transaction is below 1 crore, that please demonstrate how this transaction is at arm's length. So it will be in prudence for you that wherever there is a associated enterprise transaction or international transaction, please at least carry out a basic benchmarking to determine, and if required explain to the assessing officer how and why a transaction is at arm's length. For specified domestic transaction, as we all know, currently 5 crore is the limit, that where aggregate value of transaction exceeds 5 crore, and the set limit proposed by the budget to be increased to 20 crores is where they will be considered as specified domestic transaction. And once they are considered as specified domestic transaction, irrespective of the amount, the documentation conditions apply. The documentation is to be maintained for a period of at least 8 years from the end of the assessment year, and ought to be produced before the AO within 30 or 60 days of when it is called for. What are the requirements of documentation? Documentation for international transactions or SDT. As I said, the documentation has to be contemporaneous. It requires the documentation to be contemporaneous. What do we understand by the word contemporaneous? Anyone? Yes.
Related to the transactions.
Yes. I have written it there. I mean, it's not so difficult to read. Okay, contemporaneous has not been defined under the Income Tax Act. But what contemporaneous means is concurrent, consistent, or simultaneous. So what does that mean? The data has to be there or in existence when we are carrying out the transaction or when we are benchmarking the transaction. Inference, documentation is required to be maintained at the time of entering into a relevant transaction or at the time of benchmarking. We'll discuss the issues that this brings in. So there is a relaxation, as I said, where the transactions are below 1 crore and documentation is required to produce. Now, what are the issues when we say contemporaneous? Meaning of contemporaneous not provided. Number one, when we enter into a transaction, say at the beginning of the year or in the middle of the year or at the end of the year, do we have available information, data about comparable transactions? Answer is maybe yes, maybe no. If internal, probably yes. If external, probably no. Not that it is not available or it is always available. The answers are in gray. Whether can we use earlier years data for benchmarking or subsequent years data for benchmarking? Contemporaneous word means no. You cannot use earlier years data or you cannot use subsequent years data. However, the income tax law provides an exemption of use of earlier year data or multiple year data. Not multiple but earlier year data when the transaction or when is a long period transaction and where it has been influenced by earlier conditions. So in long term contracts, where contracts typically range for a period of over a year, contract is entered into on X date but is a 2-year contract or 3-year contract. An actual transaction could be carried out in the year 1, year 2, year 3, but prices have been agreed initially. So the benchmarking that you carried out at the time of the entering into a transaction could also be used subsequently. Updation of databases. Many a times when we are carrying out this benchmarking, the databases are not really updated. In fact, at times even when we are doing the benchmarking after the end of the year, while filing the return, while computing the study report or while compiling the 3CEB, the data available is limited, but when at the time of assessment TPO carries out the search using same filters, probably more data is available because a lot of companies file their own ROC returns only subsequently and a lot of this information is gathered from ROC only. The databases gather this information from ROC. Restatement of financials. Now we've had at least a few examples where it was found that there was a material misstatement in the financial statements and later on it was discovered and financials were restated. To give you easiest example of what everybody would probably know, Satyam. The financials were restated after 2 years. But by that time, Satyam was already used as comparable by the tax officers in several cases. Later on when it was restated, what do we use? Or when the assessee was carrying out transactions, probably it used Satyam as a comparable, it used the data and benchmarked it, but then it was found that the financial statements were incorrect. What in such cases? Difference in financial year. Now this was an issue under the erstwhile Companies Act. The new Companies Act, correct me if I'm wrong, now prescribes a constant financial year for all the companies, right? So unless I think you are required to obtain an approval, I don't know if that is permitted to have a different financial year if you obtain approval or you still have to. So in most of the cases now this will be resolved because earlier financial statements were based on the year end and a lot of companies had a non-March year end. Some of them had June, some of them had September, some of them had December based on their parent company reporting. Or not even parent company, otherwise also some companies choose a different financial year. So in that case, can you compare somebody who had a September year end to somebody who had a March year end? And which year? Earlier year, later year, which one would you use? So this gave rise to a lot of complications or is still giving rise to complications, but we have to live with it. then probably this shrinks down our universe of comparables due to these differences. And typically when I say contemporaneous, does the contemporaneous word apply only to assessee? When assessee used a particular data for carrying out benchmarking, when he conducted a search or comparability analysis on a particular date or maybe the last date of filing the return, but a tax officer has over 3 years from the end of the year, I mean to be specific, 3 years and 10 months, the time limitation period, if you look at this, to close his assessment. So by that time he would have access to lot of information which was not available to the assessee either when he entered into transaction or carried out the benchmarking. So what issues arise out of this? Now if I were to give you a simple example, assuming there was transaction of it is difficult to use share transaction as a benchmark because of the issues revolving around that, whether it is really an international transaction. The law says yes. If you read the court decision, answer is probably no, but we'll leave it at that. We'll still use it as a benchmark. So when shares are issued, at that point of time the company carries out a valuation using DCF. What is DCF? Discounted future cash flows, right? So discount your future cash flows to come at a present value. Now, as on a particular date, the management made an assessment of future cash flows. In future, I am expecting year 1 so much business, year 2 so much business, year 3 so much business, and discounted it to present value and came up with a valuation. What happens at the time of assessment? It's after 3 years. The tax officer now has actual financial statements for the projection period. What does he simply do? Replace the projections with actuals, and vis-a-vis the projection, the company performed phenomenally well, so your valuation changes, or it performed poor, valuation changed. So see the implications of how a tax officer is at advantage because he is doing the assessment after 3 years. He has a lot more information. He also has a right, and now so legal, which he can use against you, is by collecting information under 133(6) and using it against you. Of course, he has to follow procedure, give you a show cause, give you an opportunity to respond to that and refute. But yes, the tribunals have held that this could be validly used as comparable. What are the penalties with respect to this? Transfer pricing adjustment is considered as concealment, and penalties are 100 to 300% of tax sought to be avoided. Over here again the difference is the onus is on the assessee to demonstrate that the assessee had carried out appropriate due diligence while determining and fixing the prices. If the assessee is unable to demonstrate it, then it is treated as concealment. 271G, failure to furnish documentation, 2% of value of international transactions or SDT. Failure to furnish Form 3CEB 1 lakh rupees, and failure to keep or maintain required documentation, failure to produce documentation or producing incorrect information, another 2% of value of international transactions. The penalties can be huge. What are the international documentation best practices or best practices that at least we as BDO follow? Is typically for any matter we would have 5 sets of documentation. One would be the master file, which would carry information about the group, the general pricing policies. Another would be a transaction file, which would carry all the documentation about the transaction, which is agreements, invoices, FAR related documentation, so functional documentation, and pricing related documentation. Then there would be a benchmarking study, which is typically what we call the TP study report, Then there would be a TP certification file where we document our assumptions, where we document our basis or notes, and undertaking and representation from the management. So this is also one very important part when we are certifying, that is the undertakings and representation from the management, because a lot of time you would rely on certain representations made by management, and when you are certifying, what is it that you are certifying in 3CEB? Anyone?
Transaction are at the arm's length.
Okay, number one, the transaction are at arm's length, and before that all the relevant documentation and prescribed in Rule 10D have been maintained. These two things you are certifying. So when you have been held responsible, or when you are undertaking a responsibility to certify us something, I mean, all of us know as per our professional guidelines that we need to maintain appropriate documentation. So here, I mean, I think you guys can go through this at peace later. I have listed down, and this is not an exhaustive list. This is just an indicative list of what the filing should contain. So, when we are looking at various information, what could be sources of those information? So when I am looking at what is the organization structure or shareholding structure or industry classification or what is the customer profile, I should look at brochures, I should look at statutory records and registered, I should look at the website of the company, I should look at the historical annual reports, I should look at books of accounts, registrations and applications that company has made, probably to become member or to avail some tax holidays. So these are all, or these are some of the information that would provide you the details. Again, about the group, a lot of documentation which is internal to the organization or to the group. So these are the sources that I have listed down. Then information about the assessee ho gaya, group ho gaya, associated enterprise. Information about the industry. Now, a lot of times, there is a requirement to understand which industry it pertains to, what is the economics of the industry. Why is it important to understand the industry or understand the economics of the industry? Can somebody, why is it important for benchmarking?
It depends directly on the transfer pricing, fixing the transfer.
Okay. Okay. Comparables. Benchmarking. Right. Now, let me take an example. If there is an industry which is a cyclical industry, in which the entities have a life cycle. Let's talk of the mobile industry. Okay, now this industry, it is important to understand this industry. Why? Again, as they said, for appropriate benchmarking, comparability, to understand the entities involved. Where is your entity in the life cycle or in the segment? Now, if we take a mobile phone industry, can you compare Apple to a Micromax? Both are mobiles, same industry. Why? One is luxury product and other one is economy product. So these are two different segments. The economics of both the segments are very different. One is highly driven by innovation, another is more driven by usability or competitiveness in pricing or economy. Okay? Then we look at, as I said, life cycle. Which stage of life cycle are you at? So let's look at industry of FMCG. Now when you are in FMCG, can somebody give me an example of a very new FMCG product or industry, some new product or some new company or some new group? Anyone? Fast moving consumer goods. Sorry? Yeah. Anything?
Patanjali.
Okay. Patanjali products are recent entrants. They are at a particular life cycle. Now, can you compare Patanjali to the likes of Procter & Gamble, Dabur probably more so nearer to Patanjali products. Can you compare Patanjali products, or can you compare Patanjali to Dabur? No, because Patanjali is a recent entrant in market. Dabur is a settled player. Why I am giving an example of FMCG? Because when you are new entrant, probably your pricing and your profitability highly depends on competitiveness that you want to get into market. You probably are slashing prices just to get an entry into the market. Whereas if you are a settled company, you know your demand is not going to change. So you command normal margins or premium margins, right? So it is important to understand your industry, the life cycle of the industry, the various players in the industry who are there, and it is required to have those analysis incorporated or weaved into your benchmarking analysis when you carry out the FAR, when you carry out the benchmarking study. Okay? And lot of it also impacts, like for example I said that if you are using penetrative pricing as a model and you are comparing yourself with more settled player, then you need to make appropriate adjustment for that if possible. Okay, if possible, and if you are able to demonstrate and come to a reasonably certain conclusion and which can be relied upon. So industry related documentation is required. Then documentation with respect to the transaction. So about invoices, quantities, qualities. Can you compare? You were dealing in, again, let's take an example of let's say steel. Can you compare pricing of a retail steel? So somebody selling steel in smaller box to sale which is selling steels to an organization as a whole or to the manufacturers? Not really. I'm generally a little scared when these wires and water come in contact. I've seen that movie. I don't know how many of you would have seen Final Destination. So since then I'm very scared. Okay. Terms of transaction. Why are terms of transaction important? Anyone? Why terms of transaction are important?
Making the adjustment in the price.
Making the adjustment for comparability. Let me give you an example. You have two customers. One who pays you in advance or in cash, and one who takes 90 days credit. Will your price of the product to both the customers be same? Of course not. Why? You are incurring interest cost on that, which you would like to recover it. So this is the reason. So credit period is also one of the terms of transaction. Place of delivery. So what are the terms? Whether it is FOB or CIF. That is also important, so that you compare like to like. Okay. FAR analysis. Again, as I said, I'm going to lay stress again that when you are doing comparability, please understand the importance of FAR analysis, because this is the key to identifying the right comparables. Okay. Comparability itself, that is the identification of comparables, selection of methods, margin workings. Now, margin workings also need to be documented. Why are you saying that? Isn't it very simple that there is a profit before tax and there is a turnover, or there is total cost? Isn't it so simple? What is the need to document anything? So there could be non-operating income or expenses in your P&L. You need to adjust for them. There could be extraordinary items in incomes or expenses that need to be eliminated. There could be segmental, which you need to look at, probably if the business has more than one segments. Various other things. So margin workings. Now margin, when I say, is margin only profit? So when we do benchmarking, in all the cases, is it only the prices or the profits that I benchmark? Is that the only thing that we could benchmark? Any other examples anybody would like to give? Revenue per employee. In case of software industry, do you think this could be one of the basis of benchmarking? Profit per employee. Return on investment in capital intensive industries. So there are multiple other benchmarks which are possible. So don't shut your mind to looking at only comparability of net profits. There are multiple other benchmarks which are possible and could be used in conjunction, if not just by itself, for benchmarking these transactions. So the OECD in its TP guidelines recommends a 9-step process, which is no different from what we discussed earlier. Determination of years to be covered in your benchmarking or in your documentation, very important document, which period you are covering. Analysis of taxpayers' circumstances, understanding of controlled transaction based on the functional analysis, review of internal comparables if existing, identifying sources for external comparables if existing, selection of the most appropriate method and profit level indicators. As I say, PLIs are the key which you benchmark. Identification of potential comparables, determination of and making comparability adjustments, and finally, interpretation and use of the data collected and determining ALP. So these are the broad 9-step process recommended by OECD and generally followed. What is the content of a TP study? So, I thought I should include this because this is the documentation which you and I get paid for. Correct? So what is the broad layout of a TP study, or what should be included in a TP study? So these are the broad sections that we typically include. There is no standard format. There is number of documentation which is prescribed to be maintained. There are certain benchmarking analysis that you need to carry out. But this is how we document it. So our study report looks something like this, where we have the group and the taxpayer information at the beginning, industry overview and its impact on international transactions, international or specified domestic transactions per se, the FAR analysis, the selection of tested party, on what basis are we selecting a tested party. Now, as I did mention that tested party is the party whose profits you are benchmarking. What are the conditions for selecting a tested party, if anyone can share? Least complex. What else?
Availability of data.
Okay, so this session has been done. Great. Good. So that shows that you are all attentive during your sessions. Okay, thank you. So yes, so I don't need to go into that part. Identification of comparable uncontrolled transaction, which could be internal or external. Selection of the most appropriate method for determining the arm's length price. I'm sure you guys have gone through the 6 methods. Okay. Profit level indicators. I mean, I did discuss this, but has some other speaker discussed this earlier? What are the PLIs, profit level indicators? Okay, as I said, this is the ratio that you use for benchmarking. It could be other than profits also. Okay. Arm's length price itself, so determining after carrying out all the analysis what is the arm's length price, and functional adjustments to arrive at a final price used for benchmarking the international transaction. So these are the typical headings of our report. In each, what is the content? Background of the group, typically giving history of the group, its origin, its growth, business profile of the group, key business verticals and service lines, segmental revenue, geographical presence, so various things. I think you all could read this probably at later date, but I have tried to highlight key parts that we include, and mind you, this is not the only thing. It could be more, it could be different. Each one of us could develop our own way of doing it. This is just what I've shared, what we do or how we do, or what we include in the study report. what is the coverage of the transactions, the source of the industry reports or the industry reports per se, details of the transaction, the terms of transaction, quantities, qualities, basis of pricing the transactions, agreements that have been adhered to, the FAR analysis, selection of tested party, what is the reason why I am selecting a particular tested party, what are the facts which support my selection of a particular tested party. And mind you, I mean, these are things like selection of tested party, selection of most appropriate method, comparability adjustments. If you are not able to document this well and later on produce before the TPO, it is very easy for TPO to defeat your entire TP report and come up with something new. So it is not just saying that I have selected this party as tested party or I have selected this method. Why this party, why not other party? Both have to be documented. It's not that it has to be in a flow, but you have to document why the AE has been selected or the assessee has been selected, why it is a more simpler entity, why data is not available that of the other entity, that you had enough exercise or efforts made to carry out or to identify that comparable data, but was not available. So document all your efforts also. And this could be in forms of questionnaires, this could be in forms of your search exercises, this could be in forms of industry reports, various things. Identification of valid comparables by applying various filters. Now, just applying a filter is not sufficient. You have to reason, appropriately document the reason why you are selecting a filter and how does it impact. Now, for example, I mean, we've had huge debate around this, and tribunals have had different views on the subject of turnover filter. Lot of cases the tribunals have held that high turnover companies cannot be compared to a small turnover companies. The reason being, they have different economies, they are different in size, and it of course impacts the way you do business and your profits. But there are other tribunals which have said nothing doing, you can't apply a turnover filter. If you have to eliminate or remove a comparable, please demonstrate how it is different in functions, assets and risks. If there is a functional difference, only then you could eliminate a comparable. Otherwise, when functionally you are the same as the other person, then you cannot remove it from comparable just because it is high size or just because it is making extraordinary profits. Right? So it is important that you document each and everything very, very clearly in so many words. Also document the exercise or efforts that you carried to get to these comparables. It's not that you document only that these are final 5 comparables or the final 10 comparables. How you reached here? What is the universe of information you looked at? How did you select the population? What are the quantitative filters you applied? Why did you apply these quantitative filters? How does this quantitative filter impact your selection of comparables and the comparability per se? Because I have seen so many cases where the AO simply ignore a filter or change the values of your filter and your entire benchmarking goes for a toss. So to make his life difficult, you have to reason it very well so that he has to first defeat your exercise and then only apply his exercise. Okay? Similar external transactions, so comparability analysis, the adjustments. There are various adjustments. I am sure the person who would have taken up TNM would have also taken up what could be the adjustments, and I think there is one specific session also about various comparability adjustments. Could be probably. So there are various adjustments permissible, and wherever there is difference, there should be an adjustment which should be carried out. Otherwise, the comparability is incorrect. In such case, the comparables have to be rejected. Selection of the most appropriate method and then computation of PLI. So whether you should use sales as a denominator or cost as a denominator. When would you use operating profit to operating cost as a PLI? When you have a revenue transaction or when you have an expenditure transaction? So when you have an expenditure transaction, what will you use as PLI? OP2? OP2 sales, right? And when you have a revenue transaction, you use OP2 cost. Why? Because the denominator otherwise would contain tainted transaction, as what tax officers call it. Use of other ratios like Berry ratio. Exclusion of depreciation. Do you compare only PBT or you could look at also cash profits? If the condition or the industry or the transaction so demands, you could also look at comparing tax profits. So for example, which are the cases where you should look at cash profits? In a capital intensive industry, depreciation could be a huge charge, and depreciation is an accounting policy after all. Somebody believes that the useful life of asset is 5 years, some other person believes that this is 10 years. So for the same asset, they have different beliefs, so their profits would change. So you have to document these reasons whenever you use this. Determination of arm's length price. So if PLI is more than comparable margin, then at arm's length PLI is less. So this depends on situation to situation. What is the transaction you are testing? So document this. Computation of tolerance band. So there is permitted tolerance band of 3% and 1%. So you have to compute whether you fall within that band or not. Comparability adjustments, as we discussed, adjustments for risks, for working capital, functional adjustments, if possible geographical adjustment, life cycle adjustments. There are multiple differences, and each difference there can be an adjustment. But how reasonably you are able to determine and convince the TPO. What are the international developments? I thought I'll just lay down, this is something on documentation which I would recommend each of you to go through, read, because there is a lot of flavor that you get from reading these international. Transfer pricing in India, although it has evolved over the period of last 15 years, but it is still nascent. I mean, we still see the law evolving. But mind you, I mean, I have interacted with various transfer pricing experts throughout the globe, and they really respect two things about Indian transfer pricing. Number one, the creativity of Indian transfer pricing officers. Excellent creativity. Now, just to give you an example, how many of you have heard about the Maruti case? Marketing intangibles or AMP expenses? What happened? Suzuki, which is a global brand, they entered into India and they tied up with Maruti. So Maruti started selling its cars using the Maruti Suzuki brand. The cars were labeled Maruti Suzuki. So what? They paid royalty for this use of the Suzuki brand. But this TPO, who's very innovative, and he's saying, what you're doing is, Suzuki was not known in Indian market. Maruti was a local brand. Maruti had the network. So Maruti promoted the Suzuki brand in India. So forget paying royalty, you should have collected charges for promoting that brand in India. Innovative. But this has taken its course. AMP special bench confirmed that AMP adjustments were doing, but recently the High Court has ruled that down, but we are yet to see this being settled. Another innovative, Shell case, how many of you have heard? What was there in Shell case? It was a transfer of share, or it was actually investment or additional investment in shares of a subsidiary. What happened in that case? I don't know if you heard that. I'll not waste time on this. just to give you a flavor, again, I think the topic is pretty monotonous, but these kinds of cases, it makes life interesting. So Shell parent company invested in Shell shares of Shell India. While they were investing, they carried out a valuation which gave a result of value of shares were something like 8 rupees per share. So they issued or they subscribed to the shares at face value 10 rupees per share. 2 years down the line, before the assessing officer, the question came whether the value was at arm's length or not. So what did the TPO do? TPO took the actual financials, substituted them against the projections, and came to a value which was 180 rupees per share. So what does that mean? You have undervalued your share by 170 rupees. So the TPO made adjustment of 170 rupees per share and added it to the income of the assessee. This is not the end of it. What did they further do? They said, look, by doing this, what you've done is you have accommodated your AE or your parent company. The value of shares was 170 rupees per share, 180 rupees per share, but you gave them at 10 rupees. That means you have given a loan of 170 rupees to your parent company. Interest on that, make adjustment. So primary adjustment, secondary adjustment. Very creative, very creative. So I was on the point where the international community of transfer pricing experts, they respect India for two things. Number one, the creativity of Indian transfer pricing officers, and this has elevated and helped other transfer pricing officers in other countries to contain something similar. And second is the Indian judiciary or Indian tribunal decisions on this subject or on any other subject for that matter. They say Indian decisions are so well reasoned and so well evaluated, tribunal decisions, maybe at later decisions at the High Court level or Supreme Court level, that they respect the judiciary. They said that they help us understand the law of transfer pricing, the science of transfer pricing, the art of transfer pricing. So these are the two things that they respect. But nonetheless, there are these other documents and international guidances which you should refer at. Just, special reference to the last one, ATO, Australian Tax Office. This is considered to be one of the most friendly transfer pricing jurisdiction. Their website contains various guides. How do you do benchmarking? What kind of adjustments do you do? So go to the ATO website, you find a lot of information, and they are very taxpayer friendly. So this has to be ease of use. So if somebody has to do documentation, step 1, step 2, step 3, very elementary to advanced, everything. OECD has now, I don't know, how many of you have heard about BEPS? BEPS, base erosion and profit shifting. So what does that mean? So generally people are using various structures, various transactions, MNCs typically, to shift their profits from one jurisdiction to another jurisdiction, probably resulting in or with the objective of mitigating taxes or otherwise. So because of this, lot of countries were losing their profit base or tax base, and it was being shifted to, say, countries. How many of you know how big Cyprus is on the map? How big is Mauritius? How big are the Channel Islands or British Virgin Islands? May not be big, and their tax rates are smaller than they are. And that is how international community or MNEs plan and mitigate their taxes. So then this project was taken up by OECD that we want to come up with a set of recommendations or standard guidelines which each country or revenue or administration of each country can follow to come up and curb this tax evasion happening because of this planning and structuring. And one of the easiest and the most rampant way of doing it is transfer pricing. So BEPS has action point number 13 to modify the guidelines of transfer pricing and coming up with specific guidelines. You all must read it, it's a must, and this is still at consultation stage. They are yet, the changes are yet to be incorporated, the new guidelines are yet to be announced. So although lot of these recommendations are already captured in the Indian law per se, the regulations on documentation, but there are some new things which will apply. Like for example, we've discussed this master file, local file. I mean, we by default maintain it because Indian transfer pricing officer otherwise would cut you down. Very important country by country reporting, which is which is something where a M&E headquarter has to maintain certain documentation and file it with its revenue, provided yes, these are adopted and relevant agreements or relevant changes are made to the law to give in effect those agreements. So yes, country by country reporting. So what various countries, what are the transactions, profits and bases of each countries. So this is extensive reporting and a filing requirement which is set to be coming effective from 1st or proposed to be put into effect from 1st of January 2016, year beginning January 2016. So the first year would be December 2016 or any year ending after December 2016, and they would have time of 1 year to report. So this is a proposed thing. I mean, final guidelines have also been announced, but relevant changes would have to be made to laws of each country where the reporting is required. Benchmarking analysis, I think methods which all of you would have discussed, CUP method, internal CUP, external CUP, challenges in CUP, what kind of challenges that you typically face while applying CUP, resale price method, what kind of challenges that you would face in applying RPM, cost plus method, internal cost plus, external cost plus, how do you use, what circumstances, what are the challenges in applying cost plus, profit split method, the approaches, OECD recommended and the other approach for profit split, challenges in application of profit split, TNMM, practical issues in TNMM, other method. I'm sure we would have discussed the other method as well, right? Selection of most appropriate method is also discussed. This is what I mentioned, profit level indicator. What are the various other things? Cash profit ratio, return on capital employed, return on shareholders funds. In which kind of return on shareholders funds, which kind of situation it is relevant? Highly geared companies, where there is high gearing or leverage on borrowings. Revenue per employee, where the industry is a human capital based industry. Penny ratios, which is generally used in conjunction with other ratios. While identifying comparables, there are various terms. So a lot of times, people come and ask me that, look, what we have is only financials of the company. How do we determine comparability from financials? How do I compare or how do I identify whether company A is comparable to assessee or not? I only have the financial statements of the company. But when you say financial statements, what you really have is not the financial information. You have a director's report, you have an auditor's report, you have notes to accounts. In case of listed company, you also have analyst reports. Various other information is available for you to look at. And when you look at financials also, these are the financial indicators and these are the terms that they represent. So sales and net worth, they represent the size of operation. So when I have to do comparability based on size, I could look at sales or net worth. Export sales, market condition. So if I have a lot of domestic sales, can I compare it to somebody who has majority of export sales? No, because market conditions are different. Non-operating income. So somebody who has non-operating income more than 50% of his total income, is that a good benchmark for me? Probably no, because his focus is not on core activities. A lot of his income comes from non-core activities. Advertising and marketing expenditure. A company which incurs 50 crores of marketing expenditure and advertising expenditure, can I compare it with a company which incurs 10 lakh rupees on advertising in once in a newspaper and once in some Ganpati festival? I can't. So there is a functional comparability that this company does marketing as a function, the other company does not do marketing function. Foreign currency risk. So when your item has profit or loss in your profit and loss account, that means the exchange risk has been borne by you. When it is not there, that means the exchange risk has been borne by the other party. Could be the case, right? I'm not saying that this should be the case, but you need to look at these to come at saying that, okay, these are the items in financial statements which reflect functions, assets or risks. Goodwill and other intangible assets, if it appears in one balance sheet, does not appear in another, that means a particular company is probably having intangibles, whereas other does not have intangibles. Right? Economic adjustments on functional differences should be carried out on idle capacities, credit period, and return on resources. These are some very common which even the department is tending to accept. What are the Indian databases, generally which are used now? Indian databases, when I say these databases, these are primarily used for profit benchmarking and not price-related benchmarking. Because these databases that I am talking of here, there are other databases which probably could provide indication or price-based comparison, but these are more for profit-based comparison, which could be TNMM the most, or it could be resale or some other methods. I mean profit split or something, but very limited in other methods, but more so in TNMM. So Prowess, which is by CMI, and Capital and by Capital Markets. So these are two broadly used, and the recent entrant is ASTP, which we are going to see a demonstration in the next session where we take up a case study where we practically will see how to do a search on a database. Key considerations for benchmarking: understand the business and FAR completely, understand the pricing policy. It is very important that you understand how the prices are determined. If these are ad hoc, that means you are going to have a good difficulty. But if these are scientific, if the bases are appropriate, then you should document that, and that will also show the due diligence that the management did while fixing up the prices. Transaction-wise analysis versus entity-level analysis. When you do benchmarking of profits, do you do profit benchmarking of the transaction or at entity level? Document it appropriately, whatever approach you take. Both could be correct in certain circumstances and both could be wrong in certain circumstances, depending. Identify alternative source of information in public domain. Don't restrict your thought process and your search process only to the databases. Identify alternate sources of information. What could be alternate source of information? Come on. Where do you get this data? About prices, about profits, about industry conditions. Come on, few sources. BSc website, okay. Money control. What else? Companies' websites. Industry associations. CRISIL reports. Various. Don't limit your thinking. Most of the times I hear people coming back in my team, sir, इसमें तो कुछ comparable ही नहीं मिला. Then I question them. Have you looked at all your sources? Then I send them back. Then they come back. Sir, मेरे को 5 companies मिल गया. So various things. Don't restrict your thoughts. As far as possible, use multiple sources for qualitative analysis. When you do qualitative analysis, that is, is benchmarking or comparability analysis. Is the company in the same segment, in the same life cycle? Don't restrict yourself to single source. Multiple sources, as I said, website, annual reports, industry analysis reports, to say that all of them lead to the same conclusion. If they lead to different conclusion, means probably you are looking at something wrong or there is something wrong. Okay. Analyze implications of market conditions on basis of the SSE. What segment you are at, how does the market impact you, various things. Avoid cherry picking of comparables, because as it is easy for you, it is easy also for the tax officer. So use a scientific process for selecting comparable is what I would say. Loss making companies, whether to include them or not, $1 million question. Look at the situations, conditions, and document the reason for including or excluding them. The tax department would always want to exclude to show higher profitability of comparables. You may want to include it, but there are decisions also which says that if it is consistently loss making, then only you need to exclude it. If there is one-off year where losses are made, then you can include it in your comparability. But these losses are extraordinary, and if because of that one is able to demonstrate the non-comparability, then you need to exclude it. So do proper research. Maintain consistency in the process for the year while selecting comparables year on year. So 1 year I used certain filters because they were more favorable and gave me more favorable results. Next year, by using the same filter, same process, यार अभी तो वाट लग गई, अभी क्या करने का? You should have thought of this earlier. Why am I using this? Is this going to stand the test of time? Consistency maintain करना बहुत important है. So if Rohit Sharma only plays in one match, will he be selected for the next tournament? I don't know. Okay. Make suitable adjustments well backed by supporting workings and basis. When you make adjustments, supporting have to be documented. Document the whole process along with reasons, as I said earlier also. This I think will be covered by one of the other speakers, so I will not touch upon this. This brings me to the end of my presentation. I hope I was in time. And thank you. Thank you. If you have any questions, open to that. I hope I was not too fast. Okay, 60 slides in 60 minutes. I think a little over 60 minutes actually. But I think pace was okay. Or if it was fast, it would probably would have bounced. Thank you.
Any questions?
A loss-making company is while gathering the comparables. A loss-making company, can it be compared with loss-making comparables or profit-making?
So, it really depends on the facts of the case. Ideally, no business is done to make losses.
Because of depreciation or non-cash items.
So then in that case, I would, as I said, I would use probably a different PLI. I would use cash profits as benchmark. So just because I am loss making does not mean a transfer pricing adjustment to be made. I may use a different method. I may use CUP. I may use cost plus or resale price method. So what is the best suited? So don't restrict yourself, as I said, that let your imagination run free, because TPO's imagination is much more than yours. So you can use other, I would say rather than rejecting profit making comparables, I would probably choose a different PLI to benchmark. Because the officer, I'm sure, would not go by your reason that, look, I have made less loss than other loss making companies.
As I understand that consistency is the main focus for this transfer pricing. But suppose in 1 year, first year, I use that CUP method for purchase or sale of any, either CUP or TNM. So, and it is not restricted that in next year also you use that method of lookup or DNAM. So you can use any other method which is more suitable to you. So in that case, consistency is not followed from my side.
I'm sorry, I think I need to probably read the law again. It does not say more suited to you. It says more suited to the terms or the facts of the transaction. So method, most appropriate method,
Yeah.
it does not depend on what is most suited to assessee, but most suited to the circumstances. So, it is perfectly normal to change the method, but it should be justified why there is a change in method in terms of, is there a change in functions, asset, risks? Is there a change in comparability conditions? Is there a change in availability of information? So if you are able to demonstrate what were the factors which compelled you to select something in the last year and why the same factors are not applicable in the current year, or why different factors should apply in the current year, as long as you are able to demonstrate, document that there is no law which stops you from using that. The test is, each year you have to test what is the most appropriate method to determine A and B. When there are no questions, it gives an indication of two things. One, that everybody has understood everything, and two, everybody is just waiting for the break. Or third, maybe nobody has understood anything.
I think Jigar, your lecture was very good. In fact, I was trying to sleep, but you are waking up me by giving your example, like,